better than to answer some of the questions on the emerging markets, we have none other than Sunil Koul, a global emerging market equity strategist at Goldman Sachs, joining in the show right now. Sunil, hi, afternoon. Good to have you today on ET Now. And I guess the question on everyone's mind, when will the FIIs and FPIs stop selling India? Because while we didn't really care about that the last year and a half, right now it surely matters.
Yeah, I'm glad to be back. Look, before we sort of answer how, it's always difficult to predict when the flows will come back. But I think just to set the stage here, I would say, in general, the fact remains that if you look at what has happened in the global environment over the past month or so, especially after the U.S. elections, the macro environment has become much more challenging for equity markets or emerging markets in general, including, I think, India. So it's important to keep that in mind before we think about when the flows will come back, because if we are looking at an environment where your dollar is likely to be stronger once the Trump administration comes in, obviously it started moving before the US elections and those trends have continued to assert in that direction. So you're likely to see stronger dollar in the near term over the next 3 to 6 months. You're likely to see sort of more trade tensions between US and China. You're more likely to see rate cuts being pushed out because of concerns around sort of stronger growth and higher inflation in US, and sort of that environment in general is not great for sort of flows, and so we are not baking in a large amount of foreign inflows into the next 3 to 6 months into the emerging markets in general, including in India. So I think that the broader point I would make here is that the liquidity environment or the flow environment for the emerging markets, including India, is probably going to be tougher because you're not getting as much help from the external environment, and so you're much more relying on your domestic growth story. And there, I think what we would need is a stabilization on the earnings fundamentals. I think that will be critical for foreign flows to come back.
And that's exactly the point, right, Sunil? Looking at the second quarter and how it's really panned out pretty much across the spectrum, does it really feel that the growth story has gotten challenged, or do you think it's just a one-off quarter aberration that we saw?
Look, I think we had been seeing a slowdown in growth across pockets for a few months already, right? And so we actually did lower our view on India. We like the longer term structural story for India. We have been overweight the market for a while. We actually lowered it from overweight to neutral a month back, and so the timing was decent there. And I think the real reason, obviously, was that growth had been slowing down for a few months already, sort of 4 or 5 months now, across pockets, right? So we had sort of government cutting back on spending, and so the infrastructure was seeing a slowdown. Obviously, consumption we have been seeing slowdown for a while, and so our sense was that as we start to head into the earnings season, you should start to see numbers coming under pressure, which is what has already played out. I think our sense is that, look, I think the downgrade cycle is not over yet. If you look at next year, the street is still expecting around 16% earnings growth in calendar 2025. We have a below consensus view both on GDP growth, where we are at 6.3%, but also on earnings growth, where we are at 13% versus 16 from consensus, so we're 3 percentage points below. So we think that there is still one, possibly 2 quarters of downgrade still left there. We do think that if you think about this slowdown, just to be careful, we do think it's not a structural slowdown. It's a cyclical slowdown that was caused by multiple factors, partly sort of fiscal consolidation by the government, partly because of the slowdown we have seen in the consumption, sort of mass market consumption, partly because of the macroprudential measures that RBI had taken almost a year back on the retail credit side, and partly, obviously, because of the tighter sort of liquidity that RBI has kept. So all of that has actually led to the slowdown, which we think you can think about that as India sort of slowing from above trend to kind of going back to trend growth. And so we think things will start to turn much better towards the latter half of next year calendar, so towards the mid of next year, when you would start to see some rate cuts from RBI. You would start to see that the credit cycle, the retail credit cycle, we think will be sort of stabilizing by that time. Fiscal will still remain a drag because the government will continues to consolidate there. But in general, I think both the consumption cycle as well as the monetary policy cycle will start to become much more supportive. So we are sort of much more positive on the market towards the latter half of the year, because that's when we think that the cycle stabilizes.
Your Nifty target for 2025 is quite a big one. it is certainly higher than what it currently is, which means that you expect that 2025 could be a double-digit return year for the Nifty?
Yeah, I mean, Nikunj, we just to sort of set the expectations here. So we have a 24,000 target for the March 2025, which is sort of roughly sort of 4 months from now, which is flat market. So we do have a view that over the next sort of 3 to 4 months, the market will be sort of more range bound, sort of more a time correction in here. But then, as I said, as we sort of get deeper into the year, we do think that the earnings will start to recover, and so our sort of calculation here is that you basically see roughly a mid-teen earnings trajectory, 13% for calendar 2025, and a little bit higher in 2026. So so the market will sort of grind on the back of underlying earnings to a sort of double-digit 12-13% return, 13% return for the full year. So clearly, we have a 27,000 target for the full on the end of 2025. That's sort of double-digit upside from here on, but it'll be much more backloaded on the back of earnings recovery, is our sense. So we do have a flattish target over the next 3 months.
The markets moves ahead of actual events, right? So if earnings are going to be, let's say, back-ended for calendar year 2025, markets should move ahead of it. I mean, I'm just putting the historical logic here.
Yeah, of course. That's always the case. The markets are forward-looking. I think what we need to think here is that when will be the time when, I mean, it's always tricky to time markets, to be honest, Nikunj, but I think what we are sort of thinking of is that you want to get to a place wherein your global headwinds also start to moderate and your domestic is starting to sort of pick up, right? So if you sort of look at when we think that would happen, we do think that bulk of the macro pain, so to speak, in terms of stronger dollar rates higher for longer, and potentially more trade tensions will be front-loaded in the administration. And so we have a sort of 3 to 6 months steeper trajectory on those things, and then things are kind of stabilizing in the second half of the year. So I think as we get, as I said, as we get sort of deeper into the year, probably sort of more towards the June quarter, we still think that December quarter earnings are going to be softer. Probably you start to see things recovering in the March quarter, and so I think that's that's the time when you start to see stabilization in the earnings trends, as well as sort of macro starting to get a little bit better, which could be a decent point to re-engage in the market. Obviously, I think from now until then, if the market does from current levels, there will always be sort of buyers on those dips. But I think in our base case expectations, we think it would be much more towards sort of the second to third quarter when market starts to do much better.
Right. Sunil, so where is it that you see meaningful earnings growth, given that you think that this is just a cyclical problem and not a structural one? What sectors are going to lead the recovery?
Yeah, so I think even within the way we sort of think about sort of sector allocation is that, over the last year or more, we had been mostly focused on domestic sectors, and that's where bulk of the earnings was also coming through. We also saw most of the previous quarters, actually, numbers where whatever the street expectation and our expectation was, numbers were coming in ahead of expectations, and that's where earnings were getting upgraded. What we have done this year is we have made a more, for next year, in terms of our outlook, we have made a more balanced allocation to sectors. And so we have upgraded the export-oriented sectors, like IT from being market weight earlier to overweight, and then pharma from being underweight to market weight. And so in terms of the earnings pool, as well as the allocation-wise, we do think that within the domestic sectors, it would largely come in from the sectors where there is decent earnings visibility. So that would include things like autos, include things like telcos. Financials will also have a little bit of, it's a large part of the market, so they will also contribute decently to the earnings, but it will be sort of domestic sectors like autos, real estate, telcos, and then IT will also start to do much better in terms of its contribution. So those would be the key leaders in terms of what will drive the earnings growth of 13% forecast for next year.
Centered around the fact that you expect earnings recovery. So if earnings recovery is around the corner, what is that catalyst which will drive earnings recovery? Could it be domestic consumption? Could it be government spending? Could it be export recovery? Where will the catalyst come from? Because the quarter gone by was not very inspiring. We got hit on capex, we got hit on demand, we got hit in terms of both discretionary and non-discretionary spend.
Right. Yeah, so I think in terms of our own forecast, Nikunj, as I said, look, if you sort of split into those three big buckets, as you just mentioned, export is unlikely to be very strong sort of catalyst for next year, given the global environment we're talking about. I think having said that, I would still note that if you look at India's equity markets compared to many other pockets of the world, only 6% of the MSCI India revenues are go to US. I mean, sort of sales into the US. Out of that 6%, actually 4% is services revenues, largely from the IT companies. So the goods revenues is only 2% of the MSCI India, which is much lower than 15 to 25% you see in Korea, Taiwan, and other places. So the point being, I think even from the trade wars and global sort of tensions around exports, Indian equities and economy will be less impacted. But it's fair to assume that trade or exports will not be the boost to growth in here. Then you sort of are relying on both sort of investments and consumption. On the investment side, obviously private capex, we haven't still seen it being broad-based. There are sort of pockets where private capex has come back, but it's still not broad-based, and it's unlikely that it improves meaningfully in the next 3 to 6 months, given the political environment overseas. But on the government side, again, they have been sort of fiscally consolidating. There was an underspending this year because of elections, so just because of that, there will be a little bit of pickup in spending over the next 6 months. But we would be fading that, because once you start again next year, post the budget, government will likely be again sticking to fiscal consolidation, and so fiscal will still be a drag. So where we think recovery will happen is from two places. I think one, as I said, the drag on the consumption, and the latest data points, by the way, from for the month of October, started to see some pickup in sort of two-wheeler sales and some of the consumption data points. But our sense is that a lot of the drag you were getting from retail credit because of the RBI measures, and we already see that impact in the loan growth numbers, in which loan growth went from the retail loan growth went from credit growth went from sort of 20-25% to sort of 11% now. So we're already seeing it going through the system for almost a year now. So we think that will start to stabilize and recover there. And so you should start to see that in the volume growth recovery for some of the consumer names as well, and also in the credit growth numbers for the banks. So I think consumption will start to recover. And then I think the RBI rate cuts and sort of liquidity getting to sort of a surplus at the margin should also ease things. And then obviously there are sectors where earnings visibility has been decent, and so they will continue to jug along. I think all of that will mean you are at least the trajectory for earnings will start to stabilize and improve. Because right now, I think what's happened over the last 1 month in the BSE 200 is almost 7 out of 10 stocks are seeing earnings downgrades. And for example, if you look at things like earnings sentiment indicators, which look at upgrades less downgrades, they're at a 2-year low in the recent reporting season. So things have sort of our earnings have come under pressure, but I think that the second derivative of that will start to improve as we go deeper into next year.
I have one more question, which is that every 12-18 months there are some trends within trends which are at play. For example, I'm just expanding this question, Sunil, for the benefit of our viewers so that they can relate with it. This year it's been all about quick commerce. Last year it was all about financial inclusion and brokerages and NBFCs and AMCs. Another big theme right now is solar and energy transition. So for 2025, what are these mini cohorts or trend within trends which you see could outperform for 2025?
Look, I think, as I said, the good place would be sort of looking at what pockets we are sort of overweight on and what are the themes we are liking. So I think out of the different cohorts, for example, real estate continues to be, in terms of the cycle, real estate continues to be one where the cycle remains strong, and so the demand in terms of both resi and then commercial is still decent. So we like pockets of real estate, playing the pockets of real estate through the sort of the late cycle building materials, for example, so the pipes and ceramics and all of that. So I think that segment will remain strong. The high-end consumption has held up pretty well. So I think we continue to like that space. I think the thing with India, and I'll sort of get into that, but I think even though the broader message on a beta perspective over the next 3 to 6 months is constrained, we do think there is beneath the head index, there are enough pockets where people can continue to be engaged. And so in consumption, it remains high-end consumption. mass market will remain under pressure in the near term. But for example, we are seeing signs of rural recovery already, whether it's two-wheeler data, but other data points. So for example, agri as a theme, and the government has been focused on this as well. So agri as a theme in terms of sort of supply chain related companies, agri infrastructure related companies, sort of cooling, those sort of fertilizers, that sort of falls into that bucket as well. So we have a group of companies we track which are linked to the broader agri theme. So I think that could continue to improve, especially if the rural recovery becomes more visible. So I think that will be the consumption pocket. I think the EVs, we like the longer term story around sort of EVs and the energy transition. Obviously India is, like other sort of economies, is trying to be sort of self-sufficient on energy. When it comes to equity market, it's a little challenge because some of those names have done fairly well. And so we are sort of more neutral that camp because of the valuation concerns. But as a structural theme, we still think a clean energy makes sense. Tourism is another theme which hasn't seen as much slowdown, to be honest. So I think we still like pockets there. And I would say, So I think those are some of the pockets where there could still be opportunities.
Well, Sunil, really appreciate your time, and I'm so glad that you could join us today, especially on a day when looks like we are in for a good turn. When was the last time we saw 500-point recovery on the Nifty? You take out your glasses and say, okay, touch wood, guys, touch wood. 500 points on the Nifty does not happen on a daily basis. I mean, this is the kind of recovery what we saw, let's say, in May, on that election verdict when markets came down and then it actually recovered. Take the clock back, please. Take the clock back. Let's go back to May on the Nifty. Let's take it back. Stretch it by 5 months. Take it 5 months back. And what do we have? I should see 22,000. Let me use that as a round number. You have not gone below the election low, and you bounce back ahead of the election low. So I mean, with so much of news which has been thrown at us, and with that big disappointment which came on the election day in terms of what the market positioning was, 22,000 is intact, and which is where this market has found support again. So just a mathematical number, I think.
We're still higher than that number.
Exactly. And I think the news and the environment is much more noisier than what it was, at least on that day.
Absolutely. And not just India, but globally as well. So we're staying put quite okay. And of course, it's technology all the way, which is leading the gains today. Of course, there's other heavyweights like SBI, ITC, Reliance, L&T, which are all powering ahead and contributing to the Nifty move today.
If you like this video, then like, share and subscribe to ET Now.